As we continue with personal finance, investing, and estate planning, we move on to a type of investment called a mutual fund. This is a financial instrument that's going to pool investors' money together, where you're going to have more buying power, and that mutual fund is going to go purchase stocks or bonds. So you think of it as we've talked about the idea of diversification, the idea of not putting all your eggs in one basket, or not having enough money, several $100,000, to go out and buy a bunch of different companies. If you were independently wealthy and you had $1 million and you could afford to buy $20,000, spend $20,000 to buy 100 shares of this company and $100,000 of that company, and a couple $100,000 to buy these bonds or things of that nature, not many of us were able to do that. So years ago, the idea was thought up is, well, what if we do this? What if we start a business, and that business, what we're going to do is we're going to go do the work for you. You're going to pay us some fees for this, but our job is to come up with a plan. And we're going to tell you what that plan is. We're going to tell you what we're going to invest in, what types of companies we're going to buy, whether they're stock or bond or mutual fund, or stock or bond or aggressive, or are they low risk, are they high risk, are they international, are they all over the place? And what we'll do is we, the managers, the portfolio managers is the term used, the portfolio managers are going to be the professionals who will make the buying and selling decisions for you. They'll decide which stocks to own, which bonds to own, how long to own them, when they should get rid of them, so you don't have to. And what you'll be able to do is you'll be able to put a smaller amount of money in. Maybe it's a paycheck deduction. You'll see a lot of, when we get to retirement investing, a lot of things like a 401k or a 403b, they will purchase mutual funds. It's going to allow the individual investor who has limited resources the benefit of diversification without needing tons and tons of money to do so. Most 401ks and 403bs are going to be these type of retirement investments. They're going to invest in mutual funds. Many individual retirement accounts or Roth IRAs are going to also invest in mutual funds. We have several different types of mutual funds. First one is what we call a closed-end mutual fund. This is more like a stock from an individual company where there is a specific amount or a certain number of shares in this mutual fund that are going to be issued. Once the shares are issued, you can only own that company if someone who currently has the mutual fund sells those shares to you. So again, just like a stock, they're publicly traded, they're sold on a stock exchange, whether that be the NASDAQ or the Dow Jones Industrial Average or some other index. But these type of mutual funds are only a set number of shares that are issued. Most mutual funds, a lot of the 401k, 403b style mutual funds, these are open-end funds. So there's unlimited numbers of shares that anyone can buy. The idea is if Mr. Clem is the portfolio manager for Clem's mutual fund, and our stated objective is going to be we're going to invest in U.S. companies that are dealing with the auto industry and oil companies and railroad and transportation. That's our stated objective. We offer that up. People go ahead and buy shares of the mutual fund. They give us that money. I take that money and I go out there and pool it together amongst everybody's money and start buying GM and Ford and Chevy. I start buying oil stocks like ExxonMobil. I start buying railroad stocks or whatever that stated objective is. So there isn't a set number. As the dollars come in from individual investors, I pool that money. I continue to go buy more and more shares of those companies following the stated objective in what we call the prospectus. How does the value of a mutual fund happen? When they say, hey, I'm buying Clem's mutual fund at $14.50 a share. How does that math work out? The term is called net asset value. And to figure out that for a specific mutual fund, you're looking at what is being bought and sold using the following calculations. So you're looking at the value of the stocks and the bonds, the cash, whatever is the asset of this mutual fund. You're then going to subtract the fund's liabilities, which would be, vendors and accounts payable and stuff like that. And then you're going to divide that by the number of shares that are outstanding. And that formula will help you calculate your net asset value. There are fees associated. So how or why does Clem make money on this deal? Clem's going to make some money on this deal, whether it be through what's called a load or a fee. I may charge that fee on the front end, hence it's called a front end load, or I could charge that on the back end. So a mutual fund is going to have costs and fees, and some of that's dealing with the marketing, some of that is the sales commission, some of that is paying my salary for the person who's doing the research on which company should be bought or sold. Advertising, all of that is what's rolled into the mutual fund load or fee. If I charge that fee up front, it's called a front end load. If I charge that fee on the back side, it's called a back end load. Most mutual funds are going to have a sliding scale of fees. So the longer you own shares of that mutual fund from a time frame standpoint, the less of a fee it's going to be. So these are more of a back-end load where if I buy a mutual fund, I own it, and then I sell it within the first year, that load or that fee I'm going to pay at the end when I sell it is 8% if I own it for 2 full years. And again, these are just an example. Then the load goes down to 7%, all the way down to if I own the company, the mutual fund for 7 years or longer, that load goes down to 0. And you say, well, how is a company making money if they're not charging any fees or load? Well, the idea is it's an encouragement to own the company for a longer period of time, or the mutual fund, I should say. If you own the mutual fund for a longer period of time, that mutual fund has those assets or has that money to go ahead and continue buying other stocks. As you look at your different categories of mutual funds, each of them are going to have a stated objective that is in the prospectus. The investment professionals are going to follow that stated objective when they're looking at buying stocks or bonds or leaving the money in cash and what they're going to use it for. There are lots of different flavors, if you will, of mutual funds. And again, this is what is described in the prospectus. This is what tells you, all right, what kind of companies or what kind of investment strategy is this mutual fund going to use to pick and choose the stocks? I give them the money. It gives me a certain number of shares depending on what the net asset value is. I then have 50 shares at, $22.50 per share. What are they doing with it? Well, if it was an aggressive growth fund, the portfolio manager is going to pool money together and they're going to start looking at companies where their stock price is going to go quickly, where those companies are going to reinvest the profits. You could have an income or an equity income fund. Well, that's buying stocks that have a long history of paying dividends. Not all stocks pay dividends. You could look at a global stock where, again, you're buying companies just not inside the U.S. It could be companies all over the globe. And again, these are broad categories. They can get more specific than this. You could look at what's called a growth mutual fund. These are companies that have higher than average revenue and earnings, but are large and a little bit less risky. You have growth and income mutual funds. So the stated objective is to go buy companies that provide steady growth and they're paying dividends. I would argue the most popular type of mutual fund is this last one right down here, an index mutual fund. The mutual fund manager is going to pick the same companies that are used in that particular index. So we've talked about the Dow Jones Industrial Average being 30 stocks that are tracked on a daily basis. And in theory, if we had a Dow 30 index fund, the mutual fund manager's job was pretty simple. They're just going to go buy each of these 30 stocks that are tracked on the Dow Jones Industrial Average. You'll have, like an S&P 500 index fund. Well, it's Standard & Poor's tracks 500 stocks, 500 companies. That mutual fund would then purchase shares of all of those 500 different companies. So as the index goes up, you know that your mutual fund is going up. Some other flavors or different types of mutual funds. When we have an international, these are companies that are just outside the U.S. You have something called a large cap mutual fund. So it's going to invest in big companies, companies that have a market value of $8 billion or more. These are longer-term holdings, and they're probably used for retirement accounts. You look at a mid-cap mutual fund. These are companies that are kind of in the middle of the road. They have at least $500 million worth of assets, that, meaning how big is the company? Not quite $8 billion. You have small cap. These are the companies that are newer. They have market capitalization of less than $500 million. So these are more risky because they're smaller companies, but they also have the bigger potential for return because they could blow up and become pretty big someday. You have utility companies. Again, you got a mutual fund that's going to buy into companies like a Wright Hennepin or Lakes Gas or something like that, and that's their stated objective. The companies are generally safe and stable in the long run, so that you don't have companies that struggle or end up losing money.